In order to claim the credit, not only do you have to fill out Schedule EIC, but you have to compute the credit correctly. Here's Earned Income Credit Worksheet A. And this says enter your earned income. Look up your earned income in the table. We'll show you the table in just a moment. It's also in your workbook. And then enter your number from line 11 to 1040, which is your adjusted gross income. So you have to look up your earned income credit, your earned income in the table. And then if your adjusted gross income is different than your earned income, technically only if your adjusted gross income is more than your earned income, then you also have to look that number up in the same table. You'll get two different amounts, one based on your earned income, one based on your adjusted gross income. And your credit is the smaller of those two amounts. And then that's your earned income credit. So worksheet A is pretty basic. Worksheet B is if you have self-employment. So you have to calculate your earned income, which is your net profit from business, but minus you get a special adjustment for half your self-employment tax. And that's your earned income from self-employment. Add that to your other earned income to get your total earned income. So worksheet B is a little bit more complex, but basically the idea is look up your earned income, total earned income in this table, then look up your adjusted gross income if it happens to be more than your earned income in the same table. And out of those two results, pick the smaller amount of credit. So this is technically not right. You only have to look up them both up if your adjusted gross income is more than your earned income. And for most people, most of our clients, their adjusted gross income is more than their earned income because of the PFD. You're going to have $1,300 of not earned income. Okay, so here's Walter. He's single. He has one qualifying child. His earned income is $17,270, and his adjusted gross income is $24,355. So we have to look up both of those numbers. So if you want to follow along, the earned income table is in the workbook right after the tax tables. So starting on page 16. And so because his adjusted gross income is more than his earned income, then we have to look up both numbers. And so here's the earned income credit table. So his earned income is $17,000. So we're going to look for $17,000. Let's see, 17,270. So that's going to be in between 17,200 or 250, yeah, and 17,300. So it's going to be on this line here.
3,995.
Yeah. So if he's single or head of household, we're going to use this section and this column. So it's 3,995. But then, because his AGI is more, we're going to look for 24,000. $24,355, which is more than 24,350 and less than 24,400. First section, second column.
3,545.
Right. And then the smaller of those two is 3,545, and that is his credit. And you'll notice when we did the first one, this number was the same, like for all, like this whole, all these numbers are the same. The way the earned income credit works is it starts at 0. If you have 0 earned income, you also have 0 earned income credit. And it goes up by a percentage of your earned income, a different percentage depending on how many qualifying children you have. But it starts at 0, it goes up with your earned income until you reach a maximum amount or a plateau. Then it stays flat for a while, and then after a certain point, it starts going down. So it's almost like a bell curve, but a bell curve would be smooth, but it goes up, levels out, and it goes back down. So if you're on the lower part of the curve, the more earned income you have, the more credit you have. If you're on the upper part of the curve, the more income you have, the less earned income credit you get. Which is why when you're talking about non-taxable combat pay, you would have to do it both ways too, because maybe it puts you over the limit, or maybe it helps you. So you really have to try both ways to see whether you want to include or exclude your combat pay. Here's another example. Tim and Lori have 2 children, Aggie and Lon. They're filing jointly. Line 1 of their Form 1040, that's their wages, is $23,325. They also have $2,174 of unemployment benefits, which brings their AGI up to $25,499. Because their AGI is higher than their earned income, we have to look them both up. So if we're looking up $23,325 in the chart, that's going to be right here in this row. Married filing jointly is the second batch of numbers. 2 qualifying children is this amount. And then we also look up $25,499. Which is in this line, second batch of numbers, 2 qualifying children, 6604. So they're going to get $6,604 in earned income credit based on 2 qualifying children, and we're not going to dwell on these pages. But here, can't really zoom in on that. But they have both children's names, both children's social security numbers, and both children's year of birth. We skip the next section because they're both under 19, and we'll have their relationship to the taxpayers, which is daughter and son, respectively, and 12 months for both children.